You've been told your credit score measures your financial health. It doesn't. Your credit score measures how profitable you are to lenders. Here's the proof. A person with $50,000 in savings, zero debt, and zero credit cards can have a lower credit score than someone drowning in credit card debt who makes minimum payments every month. The debt-free person is financially healthier, but the bank doesn't care about your health. They care about your interest payments. And the entire credit scoring system is built around that one fact. If this is the first time you're hearing this, subscribe to Blue Plate Finance. This is exactly the kind of thing we exist to expose. Here's how the credit scoring machine actually works. You spend money. The 3 credit bureaus, Experian, Equifax, TransUnion, collect your financial behavior as raw data. They feed it into FICO's proprietary algorithm, a formula nobody outside FICO can see. FICO sells that formula to banks, insurers, landlords, even employers. Banks use your score to decide how much to charge you in interest. The bureaus sell your data. FICO sells the algorithm. Banks collect the interest. Every single time your score is pulled, somebody gets paid. And it's never you. You are not the customer of this system. You are the product. You spend money. The bureaus sell your data. FICO sells the algorithm. Banks collect the interest. And you pay to see your own score. Here are the actual rules of the credit scoring game. Rule 1. You need multiple credit cards. Not one, multiple. The system rewards complexity. Simplicity is penalized. Rule 2. Don't pay them off completely. Carrying a small balance signals you're actively using credit. A $0 balance can actually hurt your utilization score. Rule 3. Take out loans you don't need. A mix of credit types boosts your score. The system rewards you for owing more types of money to more institutions. Rule 4. Never be debt-free. Someone with zero debt and $100,000 in savings can score lower than someone with $30,000 in debt making minimum payments. Let that sink in, because owing more money means more interest payments, and more interest payments means more profit for banks. That is the entire system. Debt is not a problem for banks. Debt is their business model. Drop a comment. What's your credit score right now? And did you know the system worked this way? Yes or no below. I'm reading every single one. Here's what the Spring 2026 FICO report actually showed. Person A, $50,000 in savings, zero debt, zero cards, scores 620. Person B, $2,000 in savings, $28,000 in debt, 4 cards, scores 760. Banks prefer Person B. The average American credit score dropped to 714, continuing a downward trend since 2023. The score distribution is splitting in two. 48% of Americans now score above 750. Meanwhile, the bottom half is falling further and further behind. One missed student loan payment, 91 points gone overnight. Meanwhile, someone gaming 4 credit cards with perfect timing sits at 810 and gets the best mortgage rate in the room. You didn't design this system, but you have to live inside it. Here's how to win it. Point 1. Know which score lenders actually use. There are 40+ versions of your score. In 2026, mortgage lenders use FICO 10 and Vantage Score 4.0. Ask your lender which score they pull before you apply for anything. Point 2. Weaponize utilization. Credit utilization is 30% of your FICO score. Keep it under 10%, not 30% like most people think. Pay your card down before the statement closing date. That's when bureaus capture your balance. Not the due date, the closing date. Most people get this wrong their entire lives. Point 3. Never close old accounts. Length of credit history is 15% of your score. That first credit card you got at 22? Keep it open. Use it once a year for a small purchase. Closing it can drop your score 20 to 40 points overnight. Point 4. Check your credit report for errors. Free. 1 in 5 Americans has an error on their credit report, costing them points they didn't deserve to lose. One dispute removed can jump your score 30 to 50 points instantly. Here's what we covered today. 1. Your credit score doesn't measure your financial health. It measures how profitable you are to lenders. Those are not the same thing. 2. The system rewards debt, not wealth. Debt-free can mean lower score. That's not a bug. It's the business model. 3. The average US score just dropped to 714. The gap between top and bottom is widening every year. 4. Your blueprint. Know which score lenders use. Keep utilization under 10%. Never close old accounts. Check annualcreditreport.com for free. 1 in 5 Americans has an error costing them points. You didn't choose this system, but now you know how it works. That's your money blueprint for today. Next week, your 401k, the retirement account 60 million Americans are using completely wrong, and the default settings your employer chose that are quietly costing you thousands. Subscribe to @BloopyFinance so you don't miss it. I'm Bloopy. See you next week.